Hello and a warm welcome. My name is Shibrata Mukherjee, and today we shall make an effort to understand the concept of GDP. Before we begin with GDP, let us quickly understand the definition of a finished good. A finished good is the final end product that is purchased by a consumer, as simple as that. Say, for example, a laptop comprises of various parts: the processor, storage, hard disk, motherboard, monitor, cooling mechanisms, antivirus softwares, operating systems, and so on and so forth. Now, when we go to a shop to purchase a laptop, we pay for the final price of the laptop and not for the individual parts that it is comprised of, isn't it? Similarly, while buying a shirt, for example, we pay for the final price of the shirt and not for the yarn or the fabric that it is composed of. So, this final end product is called a finished good, and it is only finished goods that are accounted for in GDP calculations. Coming back to the basic question, what is GDP, or gross domestic product? It is the sum total of the monetary value of all the finished goods and services made within the boundaries of a country. So essentially, anything and everything in the form of finished goods or services manufactured domestically contributes towards the GDP. It includes the contribution made by the foreign companies who are manufacturing domestically, but it does not include the contribution made by citizens if they are residing abroad. Let us understand this through an example. Here's an indigenous company that obviously contributes towards the GDP of the country. You've got a foreign company invested in the country, manufacturing in that particular country. That company would also account for the GDP of the country, even though the revenue at the end of the day would go back to the parent company and the parent country. A citizen of the country residing abroad, even though remitting money back to the country, will not contribute towards the GDP of that country. Now, within this context, it is also worth mentioning about another parameter called the GNP, or the gross national product. GNP is a measurement that accounts for the monetary value of goods and services produced by the citizens of the country. Here, the contributions from the foreign companies are not counted, but the contribution from a citizen residing abroad is counted. Coming back to the same example, the indigenous company continues to account for the GNP of the nation. The foreign company's contribution is now not counted in GNP. However, the citizen residing abroad, his contribution is now counted in GNP. So, essentially, GDP is value of all the final products manufactured domestically, either by the citizens or the foreigners. The word domestic is important here. And in GNP, all the final products manufactured by citizens, both domestically and abroad, are considered. So here, the word citizens manufacturing is important. And the difference between the GNP and the GDP is called net foreign factor income. Moving on, there are two kinds of GDP: the nominal GDP and the real GDP. Let us understand them through an example. Let us assume that a country manufactures only laptop that contributes towards its GDP. Obviously, it's a hypothetical situation, but let us assume this for the sake of this example. Say it manufactures 100 laptops at a price of 1,000 rupee each. In that case, the GDP of the country would be 100,000. It's a case of simple multiplication. In year 2, for example, it manufactures 150 units of laptop and sells at 1,500 each. In that case, the GDP would be 225,000. Now, in this particular case, the increase in price over here is caused due to inflation. So, the figure 225,000, which is basically called the nominal GDP, is not a correct representation purely in forms of growth. It also includes a mixture of the inflation element in it. Had we kept the base price, which is 1,000 rupees, as same for the year 2 as the price of the laptop, and then calculated the GDP to 150,000, only accounting for the increase in manufacturing growth, then that GDP would have been called a real GDP and would have been a real representation of the actual growth that is happening without the inflation factor. So that's the difference between a nominal GDP and a real GDP. Moving on, what are the ways in which GDP is measured or calculated? You've got the income approach, the expenditure approach, and the product or output based approach. Let us start with the income based approach. As the name suggests, this type of GDP calculation is based on the total income derived as a result of production of finished goods. Let's consider what are the prime elements in setting up a manufacturing or a business unit. They are the land, labor, capital, and investor. Land is required for setting up the business unit, and the rent earned by the landlord is basically the income. Then, the laborers who work towards manufacturing of the finished good, they earn their own salary, and that is their income. The capital infusion into the business, with this capital, the bank actually earns interest, and that is the bank's income. And finally, the investor or the management earns his income by virtue of the revenue or the profits that it is generated out of the business. So the total sum of all these elements, which is the land plus labor plus capital plus management, is called the net national income. And this net national income, when added with the net foreign factor income and adjusted with depreciation, we get something called a factor cost GDP. If you remember, NFFI is GNP minus GDP that we talked of earlier in the slides. Depreciation, as you know, is logically the reduction in value of a finished goods due to the defects or loss or breakage or pilferage, etc. Furthermore, government imposes taxes for goods and services and also at times provides subsidies for the welfare. Now, when these adjustments are also taken into account along with the factor cost GDP, we get something called a market cost GDP. So, when we refer to GDP, it is generally by default the market cost GDP. Moving on to the expenditure method of measuring GDP. Unlike the income method described earlier, here, as the name suggests, the calculation is based on the expenditure associated with manufacturing of goods. The different expenditure elements could be consumers who spend to buy finished good, that's the consumption as an expenditure. Businesses who invest to buy material, plots, etc., that's investment as an expenditure. And government might also invest in various schemes and services, for example, to build roads or infrastructure or bridges, and this is called the government expenditure. The sum of all these three, along with the net exports, which is nothing but export minus import, gives you a GDP figure, and that is the figure that is approached through the expenditure method. Ideally, irrespective of the methods that is adopted, whether you adopt an income-based approach or an expenditure-based approach, the ultimate GDP number should ideally be same or at least similar. Finally, what are the drawbacks of GDP? Economists argue that GDP does not reflect the real well-being of a country. And that is because only official transactions are recorded, black monies are out of calculation. Counting foreign company incomes in GDP calculations hike up the GDP, something that we have seen or discussed earlier. GDP doesn't consider the actual benefit or quality of an end product, so whether the product has been actually useful in terms of its contribution to the society is something that is not reflected. It ignores the significance of the intermittent price of goods, thereby ignoring the fundamental parameters of economic fluctuation. Some of you might be aware that of late, in fact, even today, we have had an acute shortage of semiconductors across the world. This was due to the high demand of electronic goods during the pandemic and also because of the US China acrimony. Now, this has actually caused the impact on the production and the services across the world. But that is something which has not been considered in the GDP calculations in any format because GDP only considers the final product. Next one is GDP doesn't account for second-hand sales and finished good inventories from the previous years. So the concept of reusability or refactoring dwindles. The calculation of GDP is more inclined towards the manufacturing industry only. And finally, GDP generally doesn't reflect the true economic and social prosperity of a nation. A country having a high GDP needn't necessarily be a happy nation if its per capita GDP, or essentially GDP per person, is less due to unequal wealth distribution, which is the case more often than not. Nevertheless, in today's times, GDP still continues to provide an overall snapshot that cannot be completely ignored. There are some countries like New Zealand who are adopting the concept of something called a happiness index to reflect the actual economic and social health of their country. There is another popular way of representing GDP in terms of purchasing power parity that provides a better socioeconomic and comparative view between the countries. This is something that we have not been able to cover in this episode due to lack of time, but we shall do it sometime soon. Until then, take care and goodbye.